Hello, everyone. This is Steve Gorin, and thank you for attending today's webinar. Uh, Before we begin, I wanted to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. I'll try to answer these during the webcast, but if a more complete answer is needed or you run out of time, then I may answer it later via email. And I would encourage you that if I don't answer your question, you can just go ahead and email me. A copy of today's slide deck, as well as the most recent version of my current business succession materials, are available in the resource widget. And actually, the big PDF that's in there is slightly more updated than what's in my newsletter. I made some changes on the 28th. And then you also have a link to the newsletter in the resource widget as well. So I encourage you to download any resources or links that you may find useful. You can find additional answers to some common technical issues located in the help widget at the bottom of your screen. If you experience any technical problems during the webinar, these can also be reported through the Q&A widget. Today's presentation is CLE accredited in California, Illinois, and Texas for 1.5 hours of general credit, in Missouri for 1.8 hours of general credit, and in New York for 1.5 hours of professional practice credit for experienced and transitional attorneys. This course does not provide continuing professional education for CPAs, so anybody who wants to do that can go to my CPA Academy instructor page and find the sign up on that, and the last slide in the slide deck has a link to that. We award CLE based on attendance for the entire 90 minutes. As required, we will display secret words in 3 multiple choice polls during the presentation. You will be required to select today's secret words from a multiple choice list. Please respond to these polls to demonstrate your continued engagement and to earn your full CLE credit. We value your opinions and appreciate your participation in the course. So now let's get into it. So we're going to talk about service partnerships. Mainly what got me interested is a further update for self-employment tax issues. But while we're at it, I just wanted to mention some more pros and cons of service businesses. Then we'll talk about an assortment of 2025 tax law changes from the law that got signed July 4th, 2025. And among those changes were some changes in the qualification in terms of some like dollar thresholds for the exclusion for qualified small business stock under Code Section 1202. And I'm going to do a whole section on 1202. So I've already gone over the materials, and there's a live link in the slides to my newsletter articles, but those are already there. And again, the big PDF is there. So those of you who subscribe, you do kind of have a bonus here that you've got a little bit more recent version. I did some additional updating for the state and local income tax changes. Those are in the PDF that you have here, and they were not in the PDF that was attached to the newsletter. And then here's a slide on how to navigate between the slides and the big PDF. And I encourage you not to do that now, but to do it later when you want to go back and review what we've said. So a link to a recording of this will be sent to all attendees sometime after the webinar, like probably within a day or two. And so if you want to go back and review anything, then that would be your great time to do that. And then you can follow these instructions for that. So let's get into it. Service partnerships. So I'm going to review this Soroban Capital Partners case, and then the retired partner exception to self-employment tax, and then we'll talk about some other issues, the 3.8% net investment income tax, and Code Section 7036 buyout for service partnerships. So now, those of you who've been following what I've been doing already heard me talk about Soroban because in 2023, the tax court held that the limited partner exclusion from self-employment tax does not protect a limited partner if that limited partner is sufficiently active in the business. So that was the legal holding that set the ground for a trial to see whether the limited partners were sufficiently active to subject themselves to self-employment tax. And the tax court answered that with a resounding yes, absolutely. But some of the language in the opinion provides some insight into what cannot escape self-employment tax and what may qualify for the exclusion. Now, the limited partner's income is not subject to self-employment tax, except for guarantee payments for services rendered to a partnership engaged in trade or business. So, partners do not receive W-2s from a partnership. They receive a K-1 with a separate line that says guaranteed payments. But a limited partner is supposed to be protected from self-employment tax, except to the extent they receive guaranteed payments for services rendered to the partnership. And I've a little bit reorganized my coverage of this topic, so you can see these four bullet points here of how I've done it. The first bullet point talks about the Soroban case, and then the next case talks about where LLCs were actually treated as limited partnerships in some cases, but in other cases were not. It includes a case called Hardy, where the tax court basically ruled that they had a headless horseman there. They had an LLC that had multiple investors, all of whom had equal rights to manage, but they hired a different manager who managed the LLC, and the court said that even though they had the full rights to vote, everybody had equal voting rights. The court didn't care about that. They just said, hey, as long as they're not actually doing the work themselves, that's fine. So that's what I call a headless horseman. There's another case in there called Methvin, where it was like an oil and gas partnership, and none of the people had a right to participate. But because it was a general partnership and not an LLC with limited liability, they held that the fact that the people did not participate did not shield them from self-employment tax. So you have to have limited liability and a lack of participation in order to satisfy this rule. So then the third bullet point is IRS's approach to limited partner exception. Mainly, there's some proposed regulations that I'm going to talk about in a little bit. And then a fourth bullet point, which I'll cover a lot more, relying on the limited partner exception going forward, because as you know, I'm all about planning, trying to figure out what's the most practical approach to these developments in the law. So here on slide 8 is a link to my fourth quarter 2023 TCLE that I did a year and a half ago, where I talked about the Soroban Capital Partners legal holding, not the trial on the facts, but the legal holding that set up the trial that I'm going to be talking about. And basically they said a partner can qualify for limited partner exclusion from self-employment tax only if the partner was a passive investor. And at first blush, you would think that, well, that means that you can't avoid the 3.8% net investment income tax. And my recommendation was do an S corporation, have the individuals be limited partners. The S corporation would basically hire them as officers, and the S corp, as the general partner, would work through them as the officers of the S corporation, and therefore they were not participating in their capacity as partners. They weren't exercising any powers at all as limited partners. They're doing it only as officers of the S corp. And I went through how you can take their participation as employees of the S corp and apply it to avoid the 3.8% net investment income tax on their income as limited partners. So, it seemed like that should work, but when we go through the facts of this case, I'd say in many cases, maybe most cases, my solution won't work. So let's get into it here. I guess before we get into it more, basically the paradigms that are being set up is either you have the 3.8% tax on net investment income because you don't participate, or if you participate, then you can avoid that, but then you're caught with 3.8% self-employment tax. Now, the 3.8% self-employment tax is not as bad as the net investment income tax if you're already in the past the taxable wage base. So you're already over like about $170,000 of wages or just other income. So if you're already resigned to being in that particular scenario where you're past that, then the 3.8% tax on self-employment income tax the self-employment tax is not as bad as the net investment income tax, because the employer's portion of the self-employment tax, that's 1.45%, is deductible and reduces your income tax and also reduces the self-employment tax. It's a little recursive calculation there. So all other things being equal, I'd rather be in self-employment tax if I'm already over the taxable wage base than be under net investment income tax. But I would really rather avoid both. All right, so now let's get into it some more. So here's some facts that came out at trial. The general partner of the limited partnership was an LLC whose owners were also the only limited partners. So this does differ from my paradigm, because my paradigm is an S corp. And even though S corps are pass-through entities and partnerships are pass-through entities, partnerships are a little bit more transparent in various aspects of the tax laws than S corporations are. So that is a little bit of a distinction between these two cases. But unfortunately, I think it may be a distinction without a difference when we go through it. If you're having the tax court holding here applying. Okay, the court held that a partner who is labeled as a limited partner, who works for the business full-time, whose work is essential to generating the business's income, who is held out to the public as essential to the business, and who contributes little or no capital, is not functioning as a limited partner, regardless of the label placed on that partner. So in this case, we had the LLC that was the general partner, and the general partner appointed them to serve on various management type committees and to play an active role. So just because the LLC appointed the LLC that was the general partner appointed them, the court said that doesn't take away from the fact that they were also limited partners and they were actively involved in the business. Now, notice a couple of other things, though, in this sentence. Their work was essential to generating the business's income. And when you look at the tone of the court's opinion, the idea is that if they didn't participate in the business, it would pretty much dry up and be almost worthless. And they publicized it. So they really looked to the public as if they were general partners. That was just the perception of the public. Regardless of whether they made the correct legal disclosures, they would do the appropriate filings and disclosures. So, technically, the whole arrangement was technically presented to them, but kind of the penumbra of the marketing materials was a little bit different than some of the other disclosures that were more of a legalistic thing. And notice the court made especially a point that they contributed little or no capital. So any contribution they had was very nominal. So it was clear that the income they generated was not a return on invested capital, but rather a return based on services that were performed. And then I already mentioned in this slide to you, I kind of got ahead of myself about, they made a big deal about the fact that they were doing it more as people who were appointed by the LLC general partner to serve in that. Now, totally unrelated to this case, we do have kind of off to the side is the case a lot of people like to rely on, and I didn't put this in my newsletter. This is just something I thought of off the top of my head while talking with you, is the Frank Aragona trust case, where there was a trust and it had an LLC that managed all the trust investments, and the trustees were serving as employees of the LLC, and they were participating in that capacity. And the trustees argued that that was Michigan law, but this is the law of the vast majority of states. When a trust has a business entity that's just an instrumentality through which the trustees act, that the trustees do not take off their fiduciary duty hat and then working, through that instrumentality, they still retain their fiduciary duties. So they kind of looked through that LLC and found that the trust was materially participating, and actually it was a real estate professional and qualified for all the favorable passive loss treatment on that. So, and if you think about it, there's kind of a little bit of a substance over form going on here in that case and in this case. So the court said, I don't care that technically they didn't work directly in their capacity as partners, This is legal fiction, and in substance, they were serving as if they were general partners, so we're going to tag them. And then here's a little bit more. This is kind of the ultimate conclusion, which is kind of redundant to what I've already said. But again, look at the next to the last sentence. Their capital accounts make clear that their earnings were not of an investment nature. And then they had to pay self-employment tax. So I think in my S Corp model, the partner, the S Corporation general partner, officer probably would be imputed in their individual capacities. I mean, you could say an S Corp is different than an LLC. I think the trial court would have looked past that distinction. That's my best guess. Now, what should you do going forward? So first of all, I made no bones about it when I presented this a year and a half ago that I think the tax court was wrong. We have clear legislative history that says that if you're a general partner and a limited partner, that the general partner interest will be subject to self-employment tax, but the limited partner interest will not be. And so I think that Soroban flies in the face of that legislative history. So I think the tax court is just plain old wrong. Now, that and $5 will get you a coffee at Starbucks. So the fact that I think it is wrong doesn't mean that that you should rely on what I say instead of the tax court, because obviously the tax court is the authority here. At the same time, when you're in planning mode and you're doing whatever you can to try to avoid self-employment tax, you would like to get the most favorable facts available and then at least be able to have a threat of appealing from the tax court to a court of appeals that will actually read the legislative history and will base its decision on the legislative history as to what the statute means. So my first advice is structure the entity as a state law limited partnership. And again, that's just in the hope of having an appealable issue. Second, to the extent possible, try to establish that earnings are for investment in the business rather than the partner's personal efforts and oversight. Now, ideally, they would be contributing a large amount of capital. And in a partnership, you can take out the earnings without a second layer of tax. So you put a lot of money in, and then you could take the distributions over time, so you'll eventually get your money back. So well capitalize your partnership. Now, how do you establish that the earnings are from an investment in the business? What kind of metrics would you use? Well, the tax court didn't say anything at all about that. So I thought that I would just give you some food for thought of where you might look to see how the courts have been viewing the idea of earnings from investment. Now, in the corporate arena, we've got kind of opposite tax that the IRS takes when auditing C corporations and S corporations. In a C corporation, the IRS wants to say that the salary or other compensation that the owner employees received was unreasonably high, and therefore it's not deductible to the corporation, and it's just a pure dividend to the shareholder. In the S corporation arena, taxpayers prefer the opposite approach. They want to pay lower salaries And the IRS will say, I'm going to recharacterize these distributions as compensation income so I can charge you back FICA. Now, an interesting set-aside note for S-Corps is that often I will hear CPAs say, if you just take wages up to the taxable wage base and you don't take many wages above that, the IRS will leave you alone because the 3.8% rate, there's actually a 2.9 at a certain level, but mainly the 3.8 rate is so much smaller than 15.3%, both halves of FICA, that the IRS will leave you alone. Well, Soroban, those earnings, and I have this in my newsletter, those earnings were much, much higher than the taxable wage base. And in fact, the limited partners did receive guaranteed payments, and they did report self-employment income that exceeded the taxable wage base. It's just that the rest of the income was millions and millions and millions of dollars. And it was just too juicy for the IRS to ignore. Okay, so in both the C Corp, IRS arguing that you overpaid compensation, and in the S Corp with IRS arguing that you underpaid compensation, a very common test is the independent investor test. And the courts will say, well, what would an independent investor have required for their return on the business? And it'll look not just for dividends, but total return. Because, people will often invest for growth, and maybe you might have a corporation that pays low dividends. Like if you remember, for many, many years, Microsoft paid no dividend at all. And then it eventually started paying dividends when some of the tax rates got lower for dividends. So the idea here is, if you look at the corporation's total return net of all the compensation and other expenses, is a total return in the range of what an independent investor would say. And I've seen some cases that kind of like, they use like about 8 to 10% as the reasonable. My materials go into more detail, so I'd say go and look at the cases. So now there's two different arguments that I would make with this. So first of all, if you have contributed capital at the very beginning, that's your strongest case. But what if the company reinvested its earnings inside the company because it was expanding, et cetera? So maybe we would argue that there was the part of the return on investment, part of the earnings for the year were a return on their reinvested earnings. And I think that that's consistent with what some of the courts have done in this independent investor test. So you really have two different arguments: the original capital and the reinvested earnings. So moving on from that, is capital material income producing factor? Well, isn't that what the IRS is kind of looking, what the tax court was kind of looking at? The tax court was saying this came from services and not from investments. So to what extent is capital a material income producing factor? And so I have some comments on service businesses. I was hoping to tie the limited partner exclusion into net earnings from self-employment used for retirement plan contributions, but that didn't work out. Also consider not materially participating in the business. but significantly participating. So more than 500 hours is what the proposed regulations for limited partner under self-employment tax are using. But you can avoid net investment income tax by participating for more than 100 hours. So what if you're participating for more than 100 hours, but not more than 500 hours? Would you be a sweet spot of avoiding net investment income tax and then argue that you're not participating enough to be a general partner? Well, that might be challenging when the business owner actively works in the business. Also, the proposed regulation would require that the business owner also not have personal liability for debts and not have authority to contract on behalf of the partnership. Well, how many business owners guarantee loans? I mean, that happens all the time. And the idea of not having authority to contract on behalf of the partnership, I mean, who are we kidding? The whole point is that the owners are active in the business, and so they're contracting on behalf of the partnership. So I think it's rare that anybody would meet the proposed regulations test on what a limited partner is. But at the same time, you could go back and say, look, you know, the proposed regulation really doesn't mean anything, but it does kind of set a standard for how many hours would be, you know, triggering you over into being a general partner type of thing. So tax court, let's just go with that. So again, who knows what's going to work with the tax court, but you know, that's an argument to consider. Okay, so kind of moving past that, the self-employment tax does not apply to a qualified retiring or deceased partner, which I'm going to discuss in a moment. There's also an exception for retirement payments to insurance salesmen. One thing, insurance salesmen do like to tell their clients, well, I'm a consultant and not a salesman, because the idea that as a salesman is being pejorative. But under the tax law, being a salesman actually has more tax benefits than being a consultant. And so I remember when I practiced accounting, we had an insurance agent who branded himself as a consultant. And I said, hey, for tax purposes, how about if we call you a salesman and then you can get some more tax benefits? And he said, oh yeah, that sounds good to me. Okay, retired partner exception to self-employment tax. Self-employment tax does not apply to amounts received by a partner pursuant to a written plan of partnership which satisfies IRS requirements and provides for payments on a periodic basis to partners to continue at least until they die. So those are most likely characterized as 736A payments. And even though 736A payments are usually excluded from the draconian 409A non-qualified deferred compensation rules, payments under this provision are not excluded from 409A. Now, this exception, I'm going to show it in a minute, a little bit more about it. But before I do that, I'm going to do today's first secret word, which is tax. So hopefully we're running our poll. The secret word is tax. Please select the correct word below. You can do levy or tax or duty. And of course, tax is the correct answer. Okay, I see people are starting to answer it. I'm gonna, while you're doing that, I don't have any questions in the chat. I'm going to talk about the next slide, but I'm going to keep the poll slide open here. So a partner in a service business avoids net investment income tax if the partner materially participated for at least 3 years. And the service businesses include health, law, engineering, architecture, accounting, actuarial science, performing arts or consultants, or any other trade or business in which capital is not a material income producing factor. So a really nice thing is that you can get your permanent exclusion from the net investment income tax by working for 3 years, and then you can kind of then say, hey, okay, I'm not working anymore in the business. I'm going to avoid net investment income tax, but since I'm not working in the business, then I'm going to take the position I'm a limited partner. So anyway, okay, here we go. It looks like 79% have submitted your answers. So I'm going to go to the next one. Okay, and so here's a list of that. So again, here you get into this idea of a service partnership with this kind of a similar definition here. So if you're a professional, you're probably going to be caught. But if you're not a professional, you might be. If you're a service professional, you may very well be caught in terms of the IRS saying, hey, we're not going to let you get the limited partner exclusion if you're in a service partnership, unless you're not working the business at all. So they might say that. So I would consider those to be a little bit more vulnerable to the attack. And then you look to see whether capital is a material income producing factor or not. Now I'm going to spend a moment talking about a Section 736 buyout for service partnerships. So capital gain can be avoided on the sale of a business if the buyer forgoes goodwill amortization deductions. In order to do that, capital must not be a material income producing factor for the partnership. And so again, and I go through a lot more details on the income tax dynamics on it. So I don't really have enough time to go through that here, but I just wanted to say that if you actually have a service partnership, then you can have a more favorable buyout from an income tax viewpoint with respect to the seller financed exit of somebody. So you have a service partnership, and the existing owners are buying out the exiting owner, so we can avoid capital gain tax on that buyout. And again, my material is that 2Q1A, this cross-referenced up there in the top of that slide, that goes into those details. So you can get this benefit only if capital is not a material income producing factor, and there's a safe harbor if substantially all of the gross income consists of fees, commissions, or other compensation for personal services provided by the individual. So what I'm trying to show you here is that a service partnership may have tough times with a limited partner exception, but they've got good times for the issue on eventually being able to retire and also buyouts. And here's some more under the 736 in terms of getting that favorable buyout. Professional practice of doctor, dentist, lawyer, architect, or accountant is not treated as a business in which it's a material income producing factor, even if you have substantial capital investment in professional equipment or physical plant constituting the office. So for example, my law firm has tenant build outs. We buy lots of computers, so we do have investments going on there, but we're still considered to be professional practice. There's a little bit more guidance, again, on whether capital is a material income producing factor. These are prior laws regarding family partnerships. So I'm not going to go over that prior law, but again, trying to figure out your guidance. I don't know what the tax court is going to accept in the limited partner exclusion for getting earnings on your investment. I'm just trying to throw out a lot of different sources you could look at to try to make your case. Service partnership, there's also an anti-abuse rule under 269 capital A, where if you have a service partnership and there's income shifting going on, then the IRS considers abusive, then it can make an attack. Again, I'm not going to take the time on that. Also, I did mention before there was now I'm going to get off of that topic totally. There's a basis shifting regulation that came out under Biden, and there was onerous reporting requirements, and the Trump administration undid those numerous reporting requirements, those onerous reporting requirements, this transaction of interest reporting. You still have a lot of reporting to do under my third and fourth bullet points there, but you just don't have this transaction of interest onerous reporting. All right, now let's get into the new law, which will be a subject of the rest of today. So the lifetime gift and estate tax exemption will be $15 million on January 1st, and will be indexed for inflation, and GST exemption will be increasing as well. Probably all of you already knew that, so I'm not going to belabor the point. We've got the Code Section 199 Cap A pass-through deduction for qualified business income. And you can deduct up to 20% of qualified business income, and that is limited to ordinary income. Basically, when you look at the person's tax return, and you come down to the taxable income, then you look at how much of that taxable income is taxed as capital gain. So lop off the part of the taxable income that's taxed at capital gain rates, long-term capital gain rates. The balance of that, you compare the balance of that taxable income to your qualified business income, and the 20% is deducted on the lesser of those two amounts. Now, the qualified business income amount is further limited by what we call the wage limitation and the specified service trade or business disallowance. Now, the QBI deduction is limited. This wage limitation is the greater of 50% of the W-2 wages, or the sum of 25% of the W-2 wages, plus 2.5% of the unadjusted basis immediately after acquisition of all qualified property. So by the way, for those of you who might be fans of the movie Die Hard, so this last part, unadjusted basis immediately after acquisition, we abbreviate UBIA. And so I will recount for you the famous phrase from that, UBIA, comma, and then an expletive after that. So I have fun with that. All right. Now, so that's a limitation that caps the qualified business income. It's going to be the lesser of that, the 20% of the qualified business income, or those two bullet points, the greater of the two bullet points. Now, also, specified service trades or business are ineligible for the QBI deduction. And you can see my list here, and that list comes directly from Code Section 1202, but the engineers and architects were able to lobby successfully, and so they're not part of that list. So basically, lawyers and accountants, all of us who are practicing in those fields, we get a disallowance, but the engineers and architects do not get this disallowance. And that's because we are Satan's spawn. We're doing the devil's work, and engineers and architects are doing God's work. That's the only policy reason I can imagine for that. All right. And there's some additional issues on the specified service trades or businesses. When we really came out in the 2017 law with 199A, so that applied in 2018 and 19, I did a couple of different webinars on it. and my final webinar on that was on April of 2019, and I have a link to that webinar there, and that webinar will link you back to the other things as well. Now, this wage limitation and the specified service trader business disallowance do not apply if taxable income is below certain thresholds. So the wage limit, basically, if the original taxable income range was for married filing jointly, if you have $315,000 or less of taxable income, you got the full 20% deduction, and you did not have to apply the wage limit or the disallowance for specified service trades or businesses. And then there's a $50,000, there was a $75,000 range, so that if you had $400,000 taxable income, then those limits and disallowance apply with full force. And then if you're somewhere in between, there's a phase-in. Now, for returns other than married filing jointly, the range was 157.5 to 207.5. Now, the lower number, the 315 and the 157.5, are indexed for inflation. And then you just add, I'm sorry, I have a typo there. Let's just say 315 to 400. You're adding 100,000 or 70 or 50,000 to establish the range. So, if for 2025, the 315,000 threshold was all the way up to 394.6, and the 157.5 threshold was all the way up to 197.3. So this is before the 2025 law kicks in. 2025 law doesn't kick in until next year. So the phase-in range of limitation disallowance are 394.6 to 494.6 for 2025, and 197.3 to 247.3 for the other than married filing jointly. And the new tax law increased the range from 100,000 to 150, and from 50,000 to 75,000. So if we just kind of round it up, in that first bullet point, we had 394.6 for married filing jointly. There's going to be some inflation indexing. Just to make things easy, let's just call that around 400. And then 197, the 157.5 that got indexed to 197.3, let's just round it up to make it easy and say 200. So the new range for 2026 would be approximately 400 to 550 and 200 to 275. So you have more taxpayers who get relief, not only because of the inflation for index, but because the phase-in will give you some partial relief. All right, so that's all that I have to say about that topic. Opportunity zones. The new law establishes a permanent policy for opportunity zones, creating a rolling 10-year opportunity zone designation beginning in 2027. It also maintains opportunity zone designation process and strengthens eligibility requirements. My materials are divided into before and after. So the opportunity zone was really going to kind of expire after the 2017 law generally expired, and now this has been extended and expanded. So opportunity zones, I actually tend to rely on Kevin Matz, who's a New York lawyer who does a lot of writing on it. When ACTEC does its hour-long ALI CLE webinar on August 1st and August 5th, he's going to be talking about opportunity zones for I think about 10 minutes or so. So those who are really interested in it can sign up for the August 5th version of that webinar. So today's second secret word is bonus. Please collect the correct word from below. That's bonus. I had a question, which type of entity is best for the college athlete that would receive NIL payments? So that's name, image, and likeness. So those are not payments for services. Those are just payments for the use of intellectual property. So I would think that you would want to probably put those into an S corporation, and then you'd avoid the self-employment tax. Now I don't know whether you would avoid the net investment income tax on that type of those services, that type of income. So I'd have to go back and look to see whether the 3.8% net investment income tax would apply to that. So if it would apply to that, I would rather just have self-employment tax if the athlete is already making above the taxable wage base, which they very well may. If it's really a material amount, they probably are. Okay, so again, one last chance before I move on. Secret word is bonus. Select the correct word below. Again, that's bonus. So I'll just do 10 seconds. All right, on we go. Onward and upward. Bonus depreciation. So bonus depreciation gives 100% expensing for property used in the U.S., generally with depreciation period of up to 20 years. The 2017 tax law changes started at 100% expensing for that property, but the percentage had decreased until the new tax law restored it permanently for property acquired on or after January 14, 2025. So immediate expensing encourages not only new purchases, but also taxable acquisitions of businesses. Now, another nuance, people don't talk about it quite as often, maybe as they should, but if you have a non-grantor trust, and that non-grantor trust receives a K1, say, from a partnership or an S Corp. But I want to do a partnership because S Corps, you have ESPT and QSST and more stuff like that. So I'm going to focus on a partnership. You get a K1 from a partnership, and that K1 might have some income or loss on it. But if there's depreciation expense on that K1, and you have a non-grantor trust as an owner, that partnership is required to separately state the depreciation deduction. And the trust may be able to pass through that depreciation deduction to a beneficiary of that trust. I was asked about 10 years ago about a problem where the trustees were not active in the business, but the beneficiaries were. And so there was a concern that the loss that was generated by the business could not be deducted, and it would be subject to net investment income tax. But well, actually, that was just a loss. They were concerned about deductions because they had other income. So what we did is we passed through the depreciation to the beneficiaries, and on their returns, they say, hey, this is a separately stated item, and I'm active in the business, and therefore I can deduct it. And so that allowed a deduction of millions of dollars that really helped out the beneficiaries a lot. Somebody asked me in that second bullet point, is it January 19th instead of January 14th? And my answer is that might very well be, that probably is a typo there. So I'm gonna have to fix that going forward. So, but look at my materials to confirm the date. So my materials would have it right if I have a typo there. All right. So there's another category called Code Section 179 expense, which allows you expense basically any depreciable personal property. And so that's a broader category than bonus. And the new tax law did increase the limit. So, and it provided for more generous phase outs in favor of the taxpayer. But estates and non-grantor trusts cannot deduct 179 expense. So people who have depreciation are going to want to look for bonus depreciation. Now, if you do have a QSST or other grantor trust, then that depreciation, then that 179 passes through as a separately stated item, and then they can deduct it. All right, 163J, limitation on deducting business interest expense. So interest probably allocable to a trade or business is limited to 30% of the taxpayer's adjusted taxable income. Any deduction that's disallowed is carried forward, so it's suspended and not lost. And adjusted taxable income, it says the taxpayer's taxable income, but first of all, the first sub-bullet point there is it needs to be allocable to a business. So basically, it's your business income, and with some adjustments. And you'll see here that they do not take out deduction for depreciation, amortization, or depletion. So if you have bonus depreciation and that drives down your business income, you get to add back that bonus depreciation when you're figuring out this 30% number. So that's a very favorable change in the law. And you can say, I mentioned that benefit had expired in 2022, but the new tax law reinstated it for taxable years beginning after December 31st, 2025. So that's the immediate tax benefit this year. The business interest deduction also helps for routine business operations, also for the sales of businesses. If you do a sale from the beneficiary spouse to a slot created for their benefit, Code Section 1041 prevents recognition of gain on the sales between the spouses, but does not prevent recognition of interest income and expense arising from that sale. And the business interest expense is reported on Form 1041 Schedule E Part 2. So mechanically is deducted at arriving at gross income. So it's actually adjusted at arriving at adjusted gross income is what I meant to say. Well, actually gross income. It's sort of deducted and arriving at gross income. All right. Another change in the new tax law, which is unfavorable, is relates to compensating a partner for services rendered. So we have some provisions relating to transactions between a partner and a partnership. And so there's some like disallowance and related party transactions, that type of thing, some anti-abuse rules, and those are in the statute. And we don't have regulations that fully effectuate all of that. We actually have some proposed regulations which go into a lot of details, asking when is a profits interest given to a service partner really a disguised compensation for services rendered, which again will make you subjected to self-employment tax. And so we have proposed regulations under that. The other issue is that if it's a payment for services rendered, then it needs to be independently deductible. So let's suppose you have a family office, and the family office is a C corporation, and it's receiving its compensation as a profits interest. So it's receiving a profits interest from investment partnerships that it manages. And then because it's a C corporation, it gets to deduct all of its expenses. So any miscellaneous itemized deductions like investment management fees that the C corporation has, it automatically gets to deduct those, whereas an individual cannot deduct them. So that's a tactic for very, very high net worth families. I'd say you probably need to have a couple $1 million of investment management fees that you're worried about to really make it worth the while to do this, to do all the things required for this. Now, the lender management company was an S corp. I'm sorry, it wasn't S. It was a partnership that flowed through, I think, to an S corp, general partner, and so they had to independently prove that they had a legitimate business. Whereas if you have a C corp, you don't have to prove that. You just have to prove you're trying to profit off the investments. The lender management company did not look at this question as to whether you would treat this profits interest as, recharacterize it as a compensation for services that would be considered to be just like a fee and not a profits interest. So there's proposed regulations on that, and of course it would have been bad for the partnership to have that recharacterized as a payment, because then it would have been a guaranteed payment, which you have to independently be able to deduct, and it would be an investment management fee, which is not deductible. So I've been concerned about complying with the proposed regulations under 707A2 to try to make sure there's an entrepreneurial risk in my investment partnership that gives a profits interest to the family office C corporation. And different people have different levels of concern about what they want to do with that. But they're only proposed regulations, so arguably one could ignore them. But now the tax law says, you know, those anti-abuse rules, we're going to apply the legislative history on that. And you know, if that legislative history is consistent with the proposed regs, then you got to comply with them. And that's not literally what it said, but that is the practical effect. So I strongly encourage people, if you look at that citation there at the top of the slide in the title bar, 2C8A, that goes over those proposed regs. Okay, moving on to the next topic, itemized deductions. They reinstituted the so-called P's limitation, and they made them apply to estates and non-grantor trusts. They repealed Section 68E. This was on nobody's radar. There was no publicity whatsoever about applying this to estates and non-grantor trusts. So we know that miscellaneous itemized deductions are permanently disallowed, but who's subjected to the P's limitation? So we'll go through these next two slides. These are the itemized deductions that are potentially allowed, otherwise are disallowed miscellaneous itemized deductions. So the only itemized deductions that are left, here they are on these two slides. You notice the fourth bullet point is charitable income tax deduction, including 642C. That is an itemized deduction. And here's some other ones, including the deduction for estate tax, is the third bullet point, deduction for estate tax in case of income respective to decedent. That is a double taxation avoidance idea. If you pay estate tax on your IRA, then the IRA distributions should be able to also have a corresponding deduction for the estate tax that got paid on that income respective to decedent. That's only fair to avoid double taxation, to avoid income tax on money that already got consumed by the estate tax. So those are two, I mean, all of these disallowances are potentially unfair, but those are the two most egregious. The charitable contributions one, which I'm going to talk about in a minute, and the estate tax deduction. Now, here's another set of them as well. So if you have a trust or estate that it passes entirely to charity, that's going to generate income tax, because you won't get 100% charitable deduction. You'll get a 35/37 charitable deduction roughly, and then you'll have to pay income tax. That income tax then reduces the amount that's payable to the charity, so therefore the charitable deduction goes down because of that income tax. So you have a recursive calculation there. Maybe instead of saying recursive, I'll just say cursive. All right, I mentioned about the IRD deduction. So I say that paying IRAs and qualified retirement plans directly to charity instead of running them through your trust, that can be more important than ever. The Secure Act did allow us to get these more payable to the trust. So I have been now recommending that people pay them to the trust. But what I really recommend is that the trustee then work with the IRA provider to get it paid directly to charity and not have it run through the trust. Have the trustee direct the inherited IRA to be distributed to the charity instead of to the trust. So that can take some extra paperwork, unfortunately. More on fighting the 691C partial disallowance, maybe do a Roth conversion. So you have the income tax liability on the decedent's income tax return, and that's a pre-mortem planning. Sign an installment note, that's another pre-mortem planning. Actually, Actex fellow Lad Boyle is the one who suggested that when I was looking at this issue. And then another thing is, if you have accrued savings bond interest, you can accelerate that and put on the final return, so that can create a debt on the estate tax return, and you can actually make a post-mortem election on that. Okay, now we're going to move on to our exclusion for qualified small business stock. So I'm going to talk about the exclusion a little bit, and then I'll go into what the new law says. So qualified small business stock is eligible for 100% exclusion if held at least 5 years. If it was acquired after 2010, a partial exclusion may be available if it's between 1993 and 2010. But there's also something people don't focus on. You can do a rollover of gain from qualified small business stock into another qualified small business. So I just want to keep that in the back of the mind. I'm not going to talk about that anymore, but I just want to let you know if it qualifies for this, you can actually get a deferral instead of an exclusion, and you can mix and match on that. And my materials do have an example. Now, instead of a 5-year holding period, that is what's required for the 100% exclusion. But now, stock acquired after July 4th, 2025 is now eligible for a 50% exclusion if you hold it for at least 3 years, and a 75% exclusion if held for at least 4 years. But any gain that only has a partial exclusion, so the remaining gain is subjected to a 28% federal capital gain rate instead of the normal, 15 or 20% rate, in addition to the usual 3.8% net investment income tax rate. Now, generally, the taxpayer must have been issued stock directly by the corporation, or if you got that issued stock and you make a gift to somebody, that's okay too. The donee doesn't have to have the original issue, but the donor needs to have had the original issue. Now, when the corporation issues the stock, it cannot have more than $50 million of assets in the corporation, and that applies to that's the general $50 million for many years. For stock issued after July 4th, the threshold is $75 million, indexed for inflation. Now, and I'll get into another mention about that in a little bit. Now, if the taxpayer has eligible gain, then basically you would apply you get to have an exclusion equal to the greater of the applicable dollar limit, or 10 times the adjusted basis. I'm going to go into both of these ideas. Now, the applicable dollar limit is $10 million for stock that you acquired before July 4th, and $15 million for stock that was acquired after July 4th. So you can have some stock that you acquired a while ago, and you do the sale after July 4th, and you get only the $10 million instead of the $15 million. So it's the date of acquisition of the stock. And that $15 million is indexed for inflation. Now, that indexing for inflation is under 1202 parentheses B as in boy parentheses 4. And when they added in this indexing for inflation for the $75 million asset limitation, the law said we are going to add this provision at the end of subsection B as a new paragraph 4. So if you literally read the new law, you have two 1202B4s, one that talks about indexing the 15 million and the other that talks about indexing the 75 million. Well, if you go back and read, and my newsletter points this out, if you go back and read the addition of that indexing for inflation of the 75 million, it's in 1202D as in dog that they're discussing this. And so they obviously intended for the 75 million indexing to be added as a new D4, not as a new B4. So that's a technical correction they'll need to do. I haven't seen anybody publicly point this out, but I have seen research services listing two B4s in their service. So when you see two B4s, you'll know that one B4 is actually D4 and applies to the $75 million limitation. All right. If you have married filing separately, then you have to have those $10 to $15 million amounts. Then we talk about the following businesses that are not eligible for 1202. I mentioned that whole list of businesses already. And again, the difference between that and the qualified business income is engineering and architecture, again, because the engineers and architects are doing God's work. During substantially all of the taxpayer's holding period for qualified small business stock, the corporation must use at least 80% by value of its assets in the active conduct of one or more qualified trades or businesses. Now, substantially all, what does this mean? Do you test it daily, weekly, monthly, annually? Do you look at the holding period and multiply it by like, okay, if 90% of the holding period you qualify, that works? We don't know what substantially all means. People who lecture about 1202 and say it's a wonderful thing, I have never seen anybody give any definition to the substantially all. So I just want to point that out to you. That's a risk factor, but if you're going to have 1202 stock, I would suggest you gather documentation every year with the taxpayer's return that shows the active conduct of the business. I am unaware of any IRS examination of this, but who knows if or when they will start enforcing it. All right. Now, C corporation subsidiaries assets are taken into account. And it can even be an 80% subsidiary, if I remember correctly. But a single member LLC, does that count? And there's no statutory provision that clarifies that you get to count a single member LLC subsidiary's assets. If you have a partnership, if you have a subsidiary partnership, like you own 80% of the partnership, that absolutely does not qualify. You don't get, that would count as an asset not used in the business because the partnership interest is your asset, not the partnership's underlying business. A single member LLC, I would guess it's disregarded, and you get to count its business assets as a business asset instead of considering the LLC interest as a non-business asset. But I don't know the answer. So I strongly recommend that any C corporation that wants to get 1202 treatment should not use an LLC as a subsidiary. Instead, they should use a C corporation as a subsidiary, to be very clear about the answer here. Today's third secret word is strategy. Please select the correct word below: plan, strategy, or policy. Again, strategy is a correct word, so it would be B, strategy. Now, I did have a question in the chat that asked, did that person here write that no charitable deductions are allowable for anybody in a 37% bracket? And the answer is no. That is not correct. Somebody in a 37% bracket has a disallowance, a 2/37 disallowance. Now, I didn't get into the charitable deduction here, but there's also a 0.5% of adjusted gross income reduction in your charitable deductions. AICPA has a good example of this, and they kind of talk about the interplay. That 0.5% reduction in the charitable deduction is not a total disallowance. It generates a carry forward. So it's not a total the 237 is a disallowance. The 0.5% of adjusted gross income subtraction is not a disallowance, but rather a suspension. Of course, if you always have these limitations, then maybe we'll turn into a disallowance at some point. So I also want to mention that bunching may be a good idea for charitable deductions. You have your 0.5%, subtraction. If you apply that in year one, but not in years 2 and 3, then you avoid the problem. So you front load your charitable deduction in year 1, and then in years 2 and 3, that AGI is not taken into account because you're taking a standard deduction instead of a charitable deduction. That's the idea. It's like itemize maybe every other year, maybe every 2 or 3 or 4 years, and then just front load that charitable deduction and get it all at once, and then take advantage of the charitable deduction. So that's a possible strategy. I see we have almost 80% of the respondents, so I'm moving on. All right, getting back to strategic issues with 1202, a C corporation is not a good candidate for a sale to an irrevocable grantor trust, because those rely largely on the trust using tax distributions from the entity to repay the note. And if you pay dividends, that undermines the whole benefit of being a C corp in terms of the annual income taxation. If you distribute all of your C corp income, you have double taxation, and you have a higher level of tax than if you just had an S corp as your pass-through. So a C corporation is not a good candidate for sale to an irrevocable grantor trust. If a company's entire business is being sold, normally the buyer is going to want to have a deemed or actual asset sale. And being an S corp or partnership is more attractive. If you have an S corporation, so let me give you an example. Business is being sold for $100 million. The buyer says, I want an inside basis step up on my asset. So I want you to treat that that deems that actual sale of 100% of your stock as a deemed sale of the assets, followed by a liquidation. That's called a 338H10 or 336E election. If you look in that first bullet point where I mentioned 2Q8E IIIF, that's where I talk about this. So don't worry about writing it all down. You can just look there. So in that example, there's going to be $100 million deemed gain on the sale of all the assets. You can count that as all just pure capital gain assets. You don't have to allocate that to ordinary income, like built-in ordinary income. You can allocate only to long-term capital gain assets. And so then you have just a pure capital gain on that. And then the buyer is allowed to write off the depreciation. Now, the seller now has $100 million K1 and gets $100 million added to the basis of their stock. So when they sell their stock for $100 million, they have zero gain or loss. So this deemed asset sale, it will generate income tax on the deemed asset sale, which gives the buyer the tax benefit. But it avoids totally income taxation on the sale of that stock. Now, if you have a partnership, you can just sell the partnership interest for the profit, and that inside basis step-up applies. So even though you do pay capital gain tax on the sale of your partnership interest, there's an automatic inside basis step-up, so you don't have to have another deemed asset sale. So basically, you have one layer of capital gain tax, whether it's the sale of an S Corp or a partnership. Now, if you have qualified small business stock, the buyer is going to say, hey, I want a deemed asset sale. And then the seller is going to be like, well, then if you do the deemed asset sale, then that means that the C corporation is going to pay income tax. Then the buyer is going to say, well, there's an income tax has disappeared from the C corp, so I'm going to pay less for it. So, or the buyer might say, hey, yeah, I'm not going to require you to do the deemed asset sale because I don't want to spend the money on it. But at the same time, I'm not going to get all those deductions I wanted. And so I'm going to give you a haircut. So either way, there's a haircut going on here with the C corp, this 1202 stock, when you have a buyer who wants a deemed asset sale, and they almost always want it, or they want to get compensated for the lack of the deemed asset sale. So you're going to get the equivalent of a capital gain haircut either way if you have the qualified small business stock. It's generally from the negotiation. Again, I can't say that happens 100% of the time, but I would say it's definitely a very substantial deal point. And look at what happens, though. Do you get the 100% exclusion on the sale of the C corp stock? Well, not necessarily. You have that $10 or $15 million thing. You have the, or the 10 times rule. So you have all of those to mess with. The state might not recognize 1202. You have a risk as to whether your business qualifies for 1202 stock. Whereas if you sold your S Corp stock, you do have the capital gain on the deemed asset sale, but you have no gain on the sale of the stock for federal or state income tax purposes. So the qualified small business stock may get a haircut relating to the taxation or lack of tax benefits relating to a lack of taxation on the deemed asset sale, and may get limitations on the sale of the C corp stock. So 1202 stock may actually put you in a worse position than selling all of your S corp. Now, Oh, and this is what I just mentioned on the prior slide. So sorry if you took notes and you already could have just looked at it. Now, on the other hand, if only some of the stock is being sold, the 1202 exclusion may be a great tax savings vehicle. Because if you're selling just some of the stock of the entity, then you can't get the inside basis step up from the deemed asset sale. So then you don't have that disadvantage of the 1202 lack of deemed asset sale relative to this, because you don't have a deemed asset sale in either situation. So the 1202 exclusion may be much better then. Also, if the corporation is being liquidated without accumulating substantial built-in gain, and when I was talking about this in a committee meeting once, Carlin McCaffrey said, well, I've got a non-grantor trust and it's going to invest in a qualifying business, and then after 10 years it'll liquidate, and it's just going to get taxed at C Corp rates, which are much lower than the individual rates would apply to a tax through. And then when it liquidates, it's going to have no tax on that because it's going to be within the 1202 limits. So she was absolutely right on that. So there are some situations, in that case, they weren't going to really be investing for a big gain. They were just going to kind of, take advantage of that tax savings. Okay, also some investment structures, to simplify investment structure, annual reporting by owners, some investors prefer to use C corporations, and like they'll have a standard set of sale documents or investment documents, and they don't worry about all the nuances of tax issues because it's like we got a C corp, we don't worry about that stuff. So you may be forced into a C corp structure, and then you want to just be really sure about that. If you ultimately decide that a C corp structure is ultimately desirable, then a corporation can consider starting off as an LLC taxed as a partnership or sole proprietorship. They could deduct start-off losses. May or may not be a good idea to deduct start-off losses, but they could. And then when you determine that the C corp is ideal structure, convert to qualify small business. Do your C corp. Conversion needs to be the earlier 5 years before the sale is anticipated, or shortly before the $50 or $75 million gross asset limitation is exceeded. Now, if you do that, you get to use the greater of the value of the assets at the time of conversion or the basis of the partnership's assets. You get to use the greater of when you convert that to a C corporation and to compute your 10 times factor. So you can start off, suppose your business starts off with not a whole lot, and then you convert when the business is worth $40 million. Well, now your 10 times factor is $400 million. So that's a lot more than a $10 million exclusion or a $15 million exclusion. So you have the $400 million exclusion in that example. But in my example where you are converting that $40 million partnership to a C Corp, so you can get a $400 million exclusion, that first $40 million, to the extent that represents built-in gain, that gain is not protected by 1202 and will be taxed on the later sale of that stock. So it's a double-edged sword. Okay. I mentioned more about this. Also, when you do the conversion, if you have more than one line of business, and you start off as a partnership, you have more than one line of business, maybe divide it up into multiple businesses, and then you can have multiple C Corps that have multiple benefits of the exclusion. Finally, I want to put a little plug in for ALI, CLEs, estate planning for the family business owner. It's a great 2-day webinar, and I have a discount code for you here if you want to do that. And I also have here some links to reports on Heckerling and also save the date for my October 28th webinar, and also some other free topic resources. Somebody did ask about, what about a contribution to a DING in order to save state income tax? And the answer is, well, yes, they might, but you gotta, then you don't get the later, benefits of GST and that type of thing. And also there's kind of, limits if you did want to get GST planning. So you can do a DING, and I certainly wouldn't discourage you from thinking about that. But it's definitely not a panacea. So we've reached the end of our time. Thank you for participating on the webinar. Please complete and submit the survey that will display at the end of the session. And I look forward to future contact with you. Have a great day.